Today's topic is going to be about RMDs and explaining what an RMD is, which stands for required minimum distribution, and how you should consider taking RMDs into the future. So today we're going to take a deep dive into that, make sure you understand what they are and really how they work. Thanks for tuning in to Money in Motion. My name is Walt West, founder and CEO of the West Advisory Group. We're here to teach you how to prevent money falling through the cracks during retirement. And again, remember, it's not what you make, it's what you keep. So what is a required minimum distribution? Required minimum distribution is an amount, a minimal amount that you must take from your retirement accounts once you reach a certain age. With the current rules today, that age is anywhere from 73 to 75. And that is predicated based on the year in which that you're born. So there's some rules out there, there's some charts out there published by the IRS that tell you exactly when you need to start taking those required minimum distributions. So let's further define retirement accounts. Retirement accounts in this context are all those accounts that are pre-tax accounts. In other words, money that you put into the account that you got a tax deduction for are growing tax deferred, and you've been allowed to defer that up until the point you reach your required minimum distribution. At that time, you must take the money out and then pay taxes on those distributions. Now folks, there are very strict rules here. These distributions are a must. You have to take them out. In the event that you do not take them out, it does come with substantial penalties for not taking out those distributions. So there's other things you should know about the RMD. I want to talk a little bit about how they're calculated. So first and foremost, you take a look at your retirement accounts and you look at the value of those accounts, the ending value on December 31st of the previous year in which you must take the required minimum distribution. That calculation consists of the value of the account, your life expectancy number at that point in time in your life, which is also published by the IRS. You divide those two numbers into each other, and that determines what you're required to take out in that year. So for example, if you're 73 years of age and you're required to take your distribution that year, you would look at your retirement account balances on December 31st of the year in which you're 72 to determine what that value would be at age 73. And you must take it out before December 31st of the year in which you turn 73. And again, this calculation must be recalculated each and every year because your life expectancy changes each and every year. And of course, the value of your accounts will change each and every year. So the two key elements here is December 31st of the previous year, and then the factor of your life expectancy. Dividing those two numbers together determines the amount in which you're required to take. Now, you're able to actually take more than your required minimum distribution if you choose to do so, because you may need that for whatever purpose that you might need it for, whether it be for income or some other expense that you have the ability to take as much as you want, but you must take the minimum. One thing you must consider with RMDs is you should plan for what your potential RMD might look like during your retirement phase of life. What you might find if you're delaying distributions from your retirement accounts until required minimum distribution, you must understand that all distributions are considered ordinary income and must be placed on the front page of your 1040 form. Oftentimes, these required minimum distributions could enhance or increase your overall tax liability. So understanding what that might look like with doing the proper planning, you might find yourself in a position that you might do some additional planning, maybe doing some conversions from your tax deferred account to your tax-free account. You can look at previous videos that we produced that talk about the benefits of converting from tax-deferred to tax-free accounts and how you might minimize your future required minimum distribution. So at this point, you might be asking, well, when will I be notified about taking my required minimum distribution from my retirement accounts? Well, that's a great question. So oftentimes, financial institutions have done a pretty good job of making people aware that they have now reached that age in which they're required to take those distributions. Now, oftentimes they do not do that automatically. Some financial institutions treat that more efficiently than others. There's some financial institutions that simply won't reach out to you to let you know. You're pretty much on your own to make that decision. But you need to keep this a top of mind awareness once you reach at least age 72 and start to think through what that might look like. But again, if financial institutions do reach out, they typically would give you the ability to simply set this up on an automatic basis, where they'll simply calculate the required minimum distribution for you each and every year. And you can have it sent out on a normal frequency, let's say once per year. Maybe you want to send out once a quarter or once a month, but you have the ability to structure that RMD any way you see fit. As long as you're taking the RMD, that's fine. It requires a phone call. Simply give them a call and you'll know, so you can make the right decision so you can prevent money falling through the cracks. I am hopeful that you found this segment useful, explaining what the required minimum distributions are and how to calculate the required minimum distribution. So there's been great information here. Again, thanks for tuning in. Until next time, we'll see you then.